When we think about finance, we might think about big banks and enormous skyscrapers and millions of pounds being earned and spent. When we think about finance in the context of studying finance, it's worth thinking about the different areas of activity and the processes involved, the sorts of things that people will do on a day-to-day basis. We can look at two areas of decision making within finance and accounting: the financing decisions and the investment decisions. The financing decisions involve deciding on the best source of finance or the best combination of sources of finance for a given business at a moment in time. At a basic level, our choice is between equity and debt, issuing shares in the business, taking the owner's money to invest, and taking out loans, whether in the form of an over-the-counter loan from the bank or in the form of a loan structured like a bond, which can be traded on recognised exchanges in the same way as shares. And if at a basic level our choice is between equity and debt, at a more advanced level our choice is between different types of debt, for example fixed rate versus variable rate. We might decide to change the currency of our debt if we are expanding abroad. We might decide that exchange traded debt offers us more advantages than over-the-counter agreements. Ultimately, our financing decision is all about selecting the best combination of sources of finance, bearing in mind the costs and risks associated with each. The higher the level of debt, the higher the level of financial risk. On the other side of the decision-making process is the investment decision. Our investment decision is all about putting our funds to good use. So we see an echo of the duality of sources of funds and uses of funds. Our investment decision is ultimately deciding what to do with the money that we've obtained from shareholders or bondholders or banks in order to invest in profitable projects. We might use a technique such as discounted cash flow analysis to calculate the net present value of a proposed project to decide whether or not it is likely to increase shareholder wealth. Projects with a positive net rate of return, in other words, a rate of return higher than our cost of capital, will give a net present value which is also positive and can be said to increase shareholder wealth. We can see in our investment decision that we are basing our decisions around the objective of shareholder wealth maximisation. And while there may be other objectives to a business, and while a business may also have concern for acting as a corporate citizen, for protecting the environment, ultimately, the objective of a business has to be assumed to maximise shareholder wealth. An alternative way to look at finance and accounting is to subdivide it by different disciplines. Financial management, financial reporting, and management accounting are usually regarded as the main disciplines or areas of activity or study within finance and accounting. Other areas such as risk management, audit, and corporate governance are also relevant to any study of accounting and finance and to business decisions being made. If financial management is concerned with those investing and financing decisions, financial reporting is concerned with communicating information to users who require that information for their own economic decision making, actual and potential investors in the business and lenders to the business. And whereas financial reporting is largely about communicating to external shareholders, management accounting is largely about internal communication within the business, producing budgets, identifying variances between, say, standard and actual costs. The trade-off between risk and return is central to finance, and it is an idea which recurs in lots of different areas of finance. In an efficient market, the only way that you can really get an investment offering a higher return is to accept a higher level of risk. For example, the difference between buying shares in a company and investing in a bank account or buying a low-risk investment such as government bonds. The reverse is also true. If you want a lower level of risk, you usually need to accept a lower level of return. This risk-return trade-off is easiest to understand from the perspective of an individual investor because we all have to make investments and saving decisions. But it's a decision which is also made in many different contexts. The financial manager who is deciding on different sources of finance will look at the costs and the risks associated with each one. As a general rule, debt is cheaper than equity. It will be cheaper to borrow money than it will be to issue shares. However, borrowing more money, increasing gearing, increases the financial risk of the firm. And so again, we see the trade-off between risk and return in this case being expressed as the cost of finance.